Let's start from a different angle. When most people think of big tech stocks, they picture sky-high valuations, endless bullish narratives, and companies that are too dominant to fail. But the reality is more nuanced. Each market cycle creates opportunities where even the biggest and most famous companies are mispriced. Right now, Alphabet, the parent company of Google, is in that exact position. September is a fascinating month for markets. It's often feared, sometimes hated, but almost always misunderstood. Historically, the S&P 500 delivers its weakest average returns in September. Investors know this, traders repeat it like a mantra, and financial media loves to warn about it. Yet that fear often hides opportunities. Volatility doesn't just mean risk, it also means sharper setups for disciplined investors. And that brings us to today's focus. The question isn't, is Google too expensive? Or has the stock already run? The real question is, given the current macro environment, institutional flows, and Alphabet's fundamental drivers, is Google actually the most undervalued big tech stock of September? The evidence says yes. But before we zoom in, we need to understand the stage on which this story is playing out, the broader market. If you've been around trading communities lately, you've probably heard this question more than once. Is it time to short the market? Or should I hedge with SQQQ? It's tempting, right? After months of bullish candles, it feels like things must fall. But here's the trap, bull markets don't end when retail investors expect them to. They end when institutions decide to pull liquidity, when the data breaks down, or when macro catalysts flip. Until then, the trend is your friend, and shorting too early can be financial suicide. History is full of these lessons. In 2013, traders screamed that the market was overextended. The S&P 500 kept climbing for years. In 2020, after the pandemic crash, countless retail shorts tried to bet against the recovery. The market punished them brutally. And in 2023 to 2024, every time Nvidia looked topped out, the stock went higher, dragging the entire AI sector with it. This is why seasoned investors say, don't fight the tape. Price action and volume don't lie. Right now, both are telling us that the bull trend is intact. To evaluate any single stock, you first need to know where the market's guardrails are, those critical levels that define bullish versus bearish control. Think of these as your market seatbelt. As long as both are intact, you can lean into bullish trades with confidence. September has a reputation, but reputations can mislead. Yes, average returns are weaker. Yes, volatility spikes. But here's the nuance, many of the strongest Q4 rallies in history began in September pullbacks. Consider, the pattern is consistent, September tests patience, but it also hands institutions the chance to accumulate. And right now, Alphabet looks like the accumulation target of choice. When people think of Google, they often reduce it to the search company. That's outdated. Alphabet today is an ecosystem, so when you buy Alphabet, you're not just buying a search box. You're buying the backbone of the digital economy. And here's the kicker, compared to Apple, Microsoft, or Amazon, Alphabet still trades at a relative discount. That mispricing is the opportunity. This isn't just theory. Institutions are telegraphing their conviction in Alphabet right now. Just hours ago, a $4.2 million purchase of $250 strike calls hit the tape. That's not retail money. That's deep pocket conviction. On top of that, options flow data shows Google and Amazon leading in bullish call inflows. Translation, institutions are putting their chips on big tech to keep climbing, with Alphabet as one of the biggest bets. Volume confirms it. Trading volume in Alphabet has surged to 1.8 times its normal levels at all-time highs. This isn't weak hands chasing green candles, this is accumulation by players who move billions. Before we drill deeper into Alphabet's specific catalysts and technicals, let's recap the stage we've set. In short, the environment is bullish, the setup is favorable, and Alphabet has both catalysts and momentum. It's hard to remember now, but Google started in 1998 as a search engine with a simple mission: organize the world's information. Fast forward to today, and Alphabet is a $2.5 trillion behemoth touching nearly every corner of the digital economy. The company's story can be divided into 3 chapters. This trajectory matters because markets reward adaptability. Alphabet isn't a one-trick pony, it reinvents itself to ride each technological wave. Let's break down Alphabet's empire. When investors worry about concentration risk in Alphabet, they often forget this diversity. Ads may be the foundation, but YouTube, cloud, and AI are the growth engines of tomorrow. Here's where things get interesting. Compare Alphabet to its peers. Alphabet? Despite its size and dominance, it trades at a relative discount. Analysts peg its fair value closer to $3.5 trillion, almost a full trillion above current levels. That gap is what savvy investors look for. Volume and options flow don't just show interest, they reveal where smart money is positioning. The pattern is clear, this is classic accumulation behavior. Institutions aren't chasing FOMO, they're quietly building positions ahead of a broader re-rating. Put it all together, Alphabet? Still growing, still dominant, and still cheaper than peers. In a market looking for the next undervalued giant to re-rate higher, Alphabet is the prime candidate. Part 3, Catalysts driving Alphabet higher. Alphabet's story in September isn't just about technicals or valuation. It's about catalysts, the real-world events that shift sentiment, attract institutional flows, and reprice a stock higher. In this section, we'll break down Alphabet's major catalysts into 4 buckets. One of the most important but underappreciated catalysts for Alphabet this month comes from the legal battlefield. Specifically, the ruling against Apple requiring them to open up in-app payment systems. At first glance, this looks like Apple's problem. But that's not the full picture. Regulation doesn't exist in isolation. When it affects one giant, it reshapes the competitive landscape for all. Here's why the Apple ruling is bullish for Google. Markets thrive on narrative. Right now, the narrative forming is that Alphabet comes out of this regulatory wave looking stronger, not weaker. That's a subtle but powerful shift. Of course, Alphabet isn't immune to regulatory risk. Antitrust lawsuits have hovered around Google's ad business for years. But here's the nuance. Bottom line, regulatory pressure may create short-term volatility, but it rarely changes the long-term trajectory of a company with Alphabet's dominance. If 2023 belonged to Nvidia as the face of AI hardware, 2024 to 2025 belong to the platforms that can distribute AI at scale. Alphabet is perfectly positioned here. Alphabet's flagship AI project, Gemini, has matured into one of the leading large language models in the world. Unlike OpenAI, which relies on Microsoft's Azure for distribution, Google owns both the model and the ecosystem it runs on. Think about that, this is end-to-end AI monetization, something no other company has at Alphabet's scale. One of the least appreciated angles is YouTube's AI integration. Imagine, each of these expands YouTube's content base, increases watch time, and therefore boosts ad revenue. The monetization flywheel spins faster, and AI is the grease. Yes, Microsoft has stolen the spotlight in AI thanks to its OpenAI partnership. But don't confuse marketing with monetization. Alphabet is already embedding AI across its products with billions of daily users. Scale isn't just about having the best model. It's about having the most distribution. Alphabet wins that battle hands down. Here's the kicker, while Nvidia and Microsoft are priced as if AI will transform their earnings tomorrow, Alphabet's stock doesn't fully reflect its AI upside yet. That disconnect is where savvy investors make their money. While Wall Street debates search versus AI, the silent giant in Alphabet's portfolio is YouTube. YouTube isn't just a video site. It's the second largest search engine in the world, the largest entertainment platform, and a growing e-commerce gateway, via YouTube shopping. Remember when everyone thought TikTok would kill YouTube? Shorts has changed that narrative. This is a key strategic win. Shorts ensures YouTube stays relevant with Gen Z while retaining its older base. YouTube has multiple underutilized monetization levers. Each lever expands revenue streams beyond ads, making YouTube not just a content platform but a diversified media empire. As mentioned earlier, AI could turbocharge YouTube. Every one of these innovations compounds revenue. Analysts estimate that AI-driven YouTube tools alone could add $50 to $70 billion in value over the next decade. If YouTube is the flashy growth story, Google Cloud is the quiet but powerful one. On the surface, Alphabet lags. But here's the nuance, Alphabet's cloud business is uniquely positioned to benefit from the AI boom. Why? This positioning matters. As enterprises shift budgets toward AI, Cloud vendors that offer AI-native services will capture disproportionate share. Alphabet is lining up to be that vendor. Historically, Google Cloud was criticized for being unprofitable. That's no longer true. This is important for valuation. Investors discount ad-only businesses because of cyclicality. But when you add in a profitable, growing cloud business, multiples expand. Alphabet's most overlooked catalysts are its other bets, projects that could one day be massive. Investors often treat these as wasted money. In reality, they're venture bets funded by Alphabet's ad cash machine. If even one hits, the upside is massive. Let's recap the bullish drivers lined up for Alphabet. Combine these with institutional inflows and undervaluation relative to peers, and you have the recipe for a sustained uptrend. Part 4, Alphabet Technical Analysis and AMP, Trading Strategy. In this section, we'll break down how to trade Alphabet, covering the technical landscape, momentum indicators, risk management, and actionable strategies. The goal is to give you a step-by-step framework for trading Google in September and beyond. Before entering any trade, the first step is to understand the macro trend. For Alphabet, the macro trend remains bullish due to several factors. The takeaway: do not fight the trend. Shorting Alphabet during a confirmed bullish trend is high risk and often unprofitable. One of the most reliable bullish signals in technical analysis is the golden cross, the 50-day moving average crossing above the 200-day moving average. For Alphabet, key point: golden crosses confirm a long-term bullish trend and often attract institutional buying. Alphabet recently broke above its previous all-time high, $262, confirming a long-term bullish trend. Trading implication: a breakout with high volume is a buy signal, not a short. Even after breaking highs, historic resistance levels can serve as future targets. Fibonacci retracements and extensions are critical for projecting potential price targets. For Alphabet, trading implication: Fibonacci extensions give objective price targets to guide entry and exit points. Volume is often called the truth behind price. Trading implication: monitor volume alongside price action. If price rises on low volume, be cautious. Strong volume validates the trend. Even in a bullish trend, short-term pullbacks are normal. Trading strategy: wait for consolidation near support before buying to improve risk/reward. Risk management is critical. Alphabet's bullish trend is strong, but volatility is possible. Trading principle: adjust stop loss depending on risk tolerance. Tight stops protect capital but may get stopped out on minor dips. Wider stops require more capital but allow trend continuation. Combining Fibonacci, historic resistance, and volume. Tip: always scale out of positions as price approaches major resistance or your predefined target. For traders considering options, caution: options are high risk and require discipline. Always define your stop loss and target. The key to successful trading is integration of fundamentals and technicals. This creates a cohesive trading strategy, reducing guesswork and emotional trading. Action: buy near support on pullbacks, ride the trend with stops. Action: avoid aggressive new positions, wait for confirmation of next leg up. Action: close long positions, protect capital. Consider short-term hedges like inverse ETFs only if trend reversal confirmed. Trading Alphabet is as much about psychology as technicals.